It's no secret that things feel off economically here in the US. Indicators like the inverted yield curve and consecutive quarters of negative GDP have come and gone, and some are still around. It's also no secret that housing transactions have slowed year over year, but are gaining steam currently, let's not forget that. But overall, they're doing so primarily because of mortgage interest rates and housing costs. But also sales are being compounded by the fact that the cost of living has been obviously on the way up. People's savings are down, and debt and growth and defaults are rising on just about everything, really except for housing. Are foreclosure waves going to become a reality soon? In this video, and also because of the reported economic data, the Fed still hasn't blinked an eye at the federal funds rate because the data is still coming in strong. Some of it, like employment, is obviously doctored by the Bureau of Labor Statistics, which we have covered in prior videos. So given all of what we feel, why hasn't the worst come to pass? What can happen to our financial institutions if the Fed doesn't rethink the federal funds rate, and soon? Will bank insolvency become an epidemic like '08, and what can it do to real estate? Let's analyze that and what can come to pass. Welcome to the Big Elephant, covering foreclosures and the banking system. Foreclosures are coming, foreclosures are coming, foreclosures are coming. It's all I've been hearing for the last 2 years from various YouTube channels across the US. And why? Because of clear and obvious data that we have seen and even felt in our pocketbooks. Via the data, and according to Republican Joint Economic Committee, here in Idaho, the state inflation tracker estimates that the average household in Idaho is paying $1,101 per month to purchase the same basket of goods and services as they did in January of 2021. Cumulatively, this translates into the average Idaho household spending $26,609 more due to inflation since January of 2021. A lot of money, eh? This puts Idaho 2.3 percentage points higher than the national cumulative inflation of 19.9% since 2021. However, for the sake of length to this video, I'll leave it to the website to report this, and I'll put it in the description below. Please check it out. We, of course, are not alone. This is the United States, not just Idaho. And we can see by these graphs, credit card debt and now even defaults are on the rise here in America. But what about housing? Are foreclosures popping up in droves? Let's take a look at that data. According to Adam, a nationwide tracker, in Q1 of 2024, reported on April 11th of 2024, 95,349 U.S. properties had foreclosure filings during the first quarter. That's up 3% from the previous quarter, but down less than 1% from a year ago. 37,878 U.S. properties had foreclosure filings in March of 2024. This is down less than 1% from the previous month and down 10% from a year ago. 67,657 U.S. properties started the foreclosure process in Q1 of 2024, which is up 2% from the previous quarter and also up 4% from a year ago. Nationwide, this equates to about 1 in every 1,478 housing units having a foreclosure filing in Q1 of 2024. Bank repossessions also increased 7% from last quarter, and lenders repossessed 10,052 U.S. properties through foreclosure REOs in Q1 of 2024. This being up 7% from the previous quarter, but down 20% from the previous year. The average time to foreclose also increased 2% from the previous quarter. In Q1 2024, taking advantage of 736 days, resulting in a slight decrease from the previous quarter and representing a 20% decrease in the time to foreclose from the previous year. This downward trajectory being observed since mid of 2020. To sum it all up, 1 in every 4,286 properties had a foreclosure filing. 23,312 U.S. properties started the foreclosure process, which is up 3% from the previous month, but down 4% since March of 2023, and lenders completed the foreclosure process on 2,701 U.S. properties in March of 2024 alone, which is down 20% from the previous month and down 44% from March of 2023. But how about Idaho solely in Q1 of 2024? 317 new foreclosure filings popped up, meaning 1 in every 2,394 homes had a foreclosure filing, which was up 8.93% since Q4 of 2023 and up 49.53% since Q1 of 2023. But all in all, nationwide, foreclosures have not come up significantly and are still really below the pre-pandemic levels. So looking at it and to break it down, the foreclosures are sort of at an even playing field for the time being, with Idaho raising an eyebrow or two as a state. But to further paint this picture, how are the current foreclosures looking compared to the Great Recession? When we knew housing was in serious trouble, let's look at those numbers. In quarter 3 of 2009, there was approximately 118 million homes in the US, with foreclosure filings at about 940,000, give or take. This made 1 in every 125.5 homes in the US having foreclosure filings presented. That's a far cry off from the 1 in every 4,286 we currently have. In fact, in quarter 3 of 2010, at the peak of the completed REO foreclosures, there were approximately 280,000 completed foreclosures with the same 118 million homes that existed in the US. This would make the completed REO sit at about 1 home in every 421.4 during that time period. Currently, 1 in every 14,326 homes in the US has a completed foreclosure or REO, considering the 144 million homes we have around today. So obviously, with foreclosure filings nowhere near '08 or even reaching pre-pandemic levels at this point, and as of yet, are completed REOs slowly gaining steam since quarter 2 of 2020? Yes, and the average time it takes to complete a foreclosure is also gaining steam. So what does all this mean? Are we in trouble? Obviously not yet, but we could be. We'll get to that later in this video. However, what it is showing to me is that banks are getting more aggressive in streamlining to complete the foreclosure process. And why? It's because I think banks might be seeing the writing on the wall. In other words, get them foreclosed on while they can before a possible economic downturn, the actual effects of a recession. So what is going on with the effects of a recession? Where are they? Will we even see one? Is there a soft landing in the future? Let's take a look at that data and analyze it. The current economic outlook, according to the data, shows that consumer confidence is sitting at 97, down from 103.1 previously. ADP employment is at 152,000, down from the projected 175, but is significantly down from the 188 from the previous month. ISM manufacturing is sitting at 48.7%, down from the projected 49.6 and last month's 49.2. ISM services are sitting at 53.8, which is actually up from the projected 50.7 and up from last month's 49.4. Job openings are at 8.1 million, down from the 8.4 that was projected and from the previous month. And the U.S. employment report is sitting at 272,000, up from a projected 190,000 and up from the 165,000 we saw last month. Furthermore, and not to bore you, the unemployment rate is sitting at now 4%, up from the 3.9 from the previous month. And the U.S. hourly wages are only up 0.4%, up from 0.3 projected and 0.2 from the previous month. Hourly wages are also down, sitting at 3.9%, down from the 4.0 projected and 4.1 from the previous month. So Mike, thanks for throwing the numbers at me. What does all this mean and how does the Fed interpret it? For a majority of it, this is what the Fed wants to see: a cooling economy. Employment, at least according to ADP, is down. Manufacturing is sadly down. Job openings are down and unemployment is up. All things the broad sword of the federal funds rate wants to see. So why isn't the Fed cutting the federal funds rate? Well, unfortunately, there's a few thorns that linger, of course, and one of them being ISM services, meaning that people are spending too much money on economic services. The Fed doesn't want to see this. And surprise, 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 the U.S. employment report is up. And who is in control of the U.S. employment report? You guessed it, the Bureau of Labor Statistics. You know, the federal agency that gets creative with job reporting, as in counting secondary and tertiary jobs and even migration as employment. Nevertheless, the employment rate rose from 4% from 3.9%, the first time that it's hit that mark since January of 2022, but it's still way under the Fed's projections. Most people say they lost their jobs last month and few people entered the labor force. However, the Fed goes by the numbers. So where am I going with this? As long as the federal government keeps messing with the numbers, the Fed won't feel comfortable lowering the federal funds rate. In fact, in my opinion, the Fed may be a little bit too lackadaisical, much like they did when they said that inflation was transitory. In a condensed explanation, however, as long as the federal funds rate stays put, so will mortgage interest rates and so will chances of a full-blown recession, meaning more unemployment, bank insolvency, debt gains, loss of savings, etc., etc. On a side note, some say that the federal funds rate is not high enough. I can't disagree with that. If the Fed were to really crank the FFR and place us in a depression and the government didn't step in to fix it for votes, then the US could essentially get back on track financially. But that is a dream that will never happen, and the Fed and the government will continue to work hand in hand to kick the can down the road, if they can. We will get to that in another video. But for now, the federal funds rate is staying put, and what can happen if they hold it for too long? This would place downward pressure on businesses by means of access to needed capital, cheaper capital. As things get more expensive for businesses, that's right, layoffs, and the workers always take the brunt. So if the federal funds rate stays higher and for longer, expect unemployment to rise and foreclosure filings. But also, welcome to the second, and in my opinion, the most important discussion of this big elephant, and that's banking. I'll bet that I cover a topic that you're not aware of. Let's pivot. So what else will happen if the Fed holds out on the federal funds rate? Bank insolvency. As we already know, some banks have become insolvent recently, and more are likely to come. How so? To put it in a nutshell, let's just say that the average mortgage in America is sitting at 4%. Again, this is just an example. The federal funds rate is currently sitting at 5.25 to 5.5. This means that banks are losing money. Credit card debt is also skyrocketed. But why? Because of the federal funds rate. Unlike mortgage interest rates, which work off MBS and 10-year Treasury, the federal funds rate has an effect to the price of bills, notes, and bonds, which in a distance affects the mortgage interest rates. However, the federal funds rate directly influences credit cards, car loans, anything that's considered short-term lending. When the federal funds rate went up, credit card interest did as well, and anyone holding onto a balance went from a little to a lot due to interest. Make sense? Hence the over $1 trillion in credit card debt that is currently looming in the United States. Also, as people lose their savings, they rely on credit cards, almost to a fault, maxing them out with no care of the consequences. Hence now the rise in delinquencies. On this note, let's pivot again, but briefly. If the federal funds rate was too high, credit cards couldn't lend. So you know that banks are making money currently. According to some economists, they believe that a good chunk of the profit that banks are making right now is going to stave off some of the incoming delinquencies, with a slight profit margins to still be made. So for the banks, the credit card sit rep is not good, but they are still keeping the train rolling, probably to disaster. To sum all these up, with the average mortgage interest rate less than the federal funds rate and credit card debt where it's at, this can spell more insolvency for banks. These are just a few examples. Now, I'm not the owner of a bank, so I don't know all of it. However, it lines up the discussion. So given all this, are the banks in dire strait? Will a lot more banks go insolvent in 2024 or 2025? Well, that depends on the Fed and how much longer they're going to hold the federal funds rate. If it comes in worse, they could even raise the federal funds rate. Eek. The big elephant, though, and I bet to what you mostly don't know, is that this time, if banks go insolvent in droves like they did in '08, there will be no government bailout. Or at least there shouldn't be. The government can't afford it. We will tackle federal finances on another upcoming video. But if there's no bailout, then what? Well, how about a bail-in? Mike, what's a bail-in? Great question. By definition, a bail-in is a financial restitution tool that helps a financial institution that is at risk of failure by requiring creditors and depositors to cancel some of their debts. In other words, bail-ins provide immediate relief when banks use money from their unsecured creditors, including depositors and bondholders, to restructure their capital. If banks use a bail-in, basically the bank uses money from depositors and unsecured creditors to help them avoid failure. This also includes depositors whose accounts balances are more than the FDIC insured limits. Oh my goodness. So if they use it, the banks will have authority to take control of any capital that fits the criteria per the law. Investors with accounts that have exceeded the $250,000 insured limit may be infected. In other words, since the American taxpayer didn't like bailouts in '08, now the banks will just come after you and yours. Bail-ins allow banks to avoid bankruptcy by shifting risks to their creditors rather than to the taxpayers. The risk then can be transferred to bank customers too. This means that debit holders, unsecured creditors, shareholders, and depositors may shoulder problems within the financial sector when banks use bail-in measures. Mike, how is this even legal? That's another great question. Unbeknownst to most, It was established under control of the Dodd-Frank Wall Street Reform and Consumer Act. You know, that legislation that prevented predatory lending that resulted in the '08 financial crisis. So if a bail-in happens, at least my deposits are protected up to $250,000 FDIC insurance standards, right? Well, let's dive into this. But first, let's get a little background on what would happen if there were just bank runs due to multiple cases of insolvency. There are more than $22 trillion in deposits currently in the U.S. banking system. Before we go any further, question. Do you think the FDIC is funded anywhere near the $22 trillion if there's a systemic collapse or if multiple banks fail simultaneously? The answer is most definitely no. The FDIC has $124.5 billion on its balance sheet and a line of credit from the U.S. Treasury for $100 billion. Even in the case of multiple bank runs, the FDIC assets could only cover 1.26% of current deposits. The additional $100 billion line of credit would equate to about 2% of all deposits. Ugh. Also, the Dodd-Frank Act allows between 3 to 5 years for the FDIC to complete a liquidation. So, in a significant banking crisis event, it could be years before depositors get paid their money, if any money is left to pay them. Payment would also be negotiated on first come and according to priority. In a controlled situation with only one small or two medium-sized bank failing, the FDIC can manage the bankruptcy and pay every depositor. However, bank runs are not well organized and easily managed events. If another banking crisis, like the size of the 2008, the FDIC is not financially ready to pay the claims, period. And to further the problems, announced on March 15, 2020, the Fed Board reduced the reserve requirement ratios to 0% effective March 26, 2020. This action eliminated reserve requirements for all depository institutions. But back to bail-ins. If a majority of the banks go belly up with most likely no bailout, what do you think are the chances of the financial system going after a bail-in? I would say I'd want to take bets, but I don't want to. Neither should you. So talk to your financial advisor today about protecting yourself from this possible reality. The people of Cyrus learned the bail-in lesson back in 2013. Do you think our government, the Fed, or the FDIC would even care about the FDIC's protection limits if a bail-in were to occur? I'm not going to bank on that. Bank. Get it? What then would happen to housing? Well, you do the math. So, given all this information, what do I see coming for housing, and how will I know if these problems start casting a bigger shadow? Well, first, and in my humble opinion, HELOCs will increase, as people can't afford to maintain their lifestyles or just basic living expenses. This is a stat that I'm closely watching, and you should too, even if you're a realtor and you're watching this video. In my opinion, it'll show me how many homeowners are out there essentially going belly up, pulling from their home's equity to afford the home they're in and pay off bills. Also, if the federal funds rate doesn't decrease, and hopefully sometime soon it does, you can guarantee that eventually unemployment begins to rise. This will definitely increase short sales and foreclosure filings in the US. If housing were to fully crash due to a wave of foreclosures or excessive inventory on the markets, in my opinion, what would happen? BlackRock subsidiaries would be there to pick up the properties, turning homes into what? You guessed it, rentals. Not a far cry for a company that has the third largest GDP in the world to accomplish. You will own nothing and be happy. Man, I'm sure I've heard that somewhere before. The upcoming NER settlement is also not going to help things by creating a distinction between buyer and seller's commissions for professional representation, obviously placing more pressure on the buyers to purchase a property effectively. And if unrealized capital gains tax hits the US, homeowners will fall in droves. This is a topic for another video, so please stay tuned. So all in all, what can be done about it? If things are going to pivot here in the US, we have to start making money. For example, American independent energy has to return, a return to US manufacturing, capping Congress on its ridiculous spending spree. Inflation is going to be a thorn for all if these things are not tackled. And eventually, our least dirty shirt will become way more dirty. Then we all pay the consequences. So keep this in mind when you hit the voting box in November, and let's do what we can to save this country. In the meantime, let's keep our eye on the numbers, the Fed, and pray for the best. If you have any further questions, of course, feel free to reach out to me. Happy to answer. But given all of this, there are silver linings that I will discuss in upcoming videos. So please hit the subscribe button hit the notification bell so that you're constantly tuned with the videos that I do come out with. And regardless, all of us don't have a crystal ball, and none of us know if any of this is even going to come to pass. Like others currently in the market, housing is a necessity. So if you find yourself looking to buy, sell, or invest, or even rent now, please feel free to reach out to me. I'm more than happy to help. I can be reached via the number below, or feel free to email me or shoot me a text. More than happy to answer any of your questions or get the process started in the direction for you for your home purchase right here in the greater Boise, Idaho area, better known as the Treasure Valley. If you found this information useful, please share it with somebody else that you do know. Also, please give me a thumbs up if you did like this information and you found some of its content useful. It always does help out the algorithm. And I do look forward to that day that we speak. So again, I look forward to the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.